Apparently, AI stocks are in a bubble.
Are we in an AI bubble? Of course.
Are we in an AI bubble?
I absolutely believe we are.
Feels exactly like 1999. I think all the ingredients are in place.
Even Sam Altman, the creator of Chat GPT,
You know Chat GPT? I love Chat GPT. I love it.
and one of the biggest advocates for artificial intelligence, seems to agree. Now, to be honest, we're in a bit of a tricky spot. On the surface, these AI firms look like they're generating healthy profits. But the big question is whether those profits are genuine or whether they're being inflated by clever accounting and circular funding. I'll come back to that in a bit. Here's the thing though, right now just 10 major US tech companies make up around 40% of the entire S&P 500 by market size. So if this so-called AI bubble does pop, investors could be looking at some very serious losses in their portfolios. But don't panic just yet, because in this video I'll walk you through 3 smart ways to protect yourself. But before we get into all that, let's take a quick reality check. Everyone loves comparing today's AI boom with the dot-com bubble back in 2000. But honestly, the world and the market are very different from 25 years ago. Back then, investors were completely caught up in the internet euphoria. Companies with no revenue, no profits, sometimes not even a proper business model, were trading at astronomical valuations because everyone believed the internet guaranteed endless growth. But when interest rates went up and the profits failed to appear, the market just collapsed brutally. The Nasdaq fell by around 83% and it didn't recover for about 15 years. As a result, a lot of companies simply disappeared. But here is the interesting thing. Even in all that chaos, some companies survived. And some sectors even outperformed quietly, making serious money for anyone who stayed invested. Value stocks outperformed those expensive growth names. Defensive sectors like consumer staples, healthcare, and utilities gave investors some stability. Gold soared, bonds rallied as interest rates fell, and international markets, especially emerging economies like China, actually outperformed the US for much of the 2000s. So if today's AI boom fades, we might see similar patterns again. That's why the dot-com crash still offers some important lessons for what's happening right now. But while the similarities are real, the differences are just as important. And here are the key ones. Unlike 1999, today's tech giants are genuinely profitable. Nvidia's operating margin, for example, is around 62%. An almost unheard of level for a company its size. The Magnificent Seven now make up about 1/3 of the S&P 500's market capitalization and nearly a quarter of its total earnings. They also sit on enormous cash reserves, very different from the over-leveraged internet startups of the early 2000s. And importantly, monetary policy today looks completely different. The Federal Reserve in the US is easing, not tightening. Which means if markets do stumble, central banks actually have room to act. Even if a few AI startups do fail, the infrastructure, the data centers, chips, and software will still hold lasting value. So even though there are some similarities to the dot-com bubble, the foundation today is far stronger. That doesn't mean there won't be corrections, of course. There absolutely will be. But they're more likely to look like market rotations, not complete collapses. At least that's my view. Now the question remains, are we really in a bubble? The truth is, it's incredibly hard to know in real time. You only know for sure once it's already burst. But we do have some pretty loud warning signs. On one hand, valuations are extremely high. For instance, Nvidia's P/E ratio is 54, Microsoft's is 38, and Tesla has a massive P/E ratio of 259. So investors are paying hundreds of dollars for every single dollar of profit, which effectively means they're betting on endless growth. Another strange feature of this boom is the so-called circular AI economy, where companies like Nvidia invest in AI startups such as OpenAI and xAI, and those startups in turn spend big money on Nvidia chips. Then both companies report booming growth, but much of the money just spins in circles, creating the illusion of unstoppable demand. Now, it's not exactly fake revenue since the cash flows are real. But it's not exactly sustainable either. If venture funding slows or if investor enthusiasm fades, that whole feedback loop could easily break, and those growth numbers might suddenly look a lot weaker. And look, if you actually use AI tools every day,
I love AI. Do you use AI?
you probably already know that they are helpful, sure. But for critical work, they're still far from perfect. In fact, the recent MIT report found that 95% of generative AI projects in companies are failing. That suggests adoption is slower, harder, and far more expensive than the headlines make it sound. So yes, there are signs of a bubble, extreme valuations, circular revenue, and over-optimism. But on the other hand, AI technology is real, the profits are real, and the infrastructure has long-term value. So maybe it's not a bubble in the classic sense, and there are valid reasons to be optimistic, especially if you're investing for the long term and don't worry too much about short-term volatility. Maybe it's just an overexcited market, one that's pricing in too much too soon. Either way, euphoria never lasts forever. So if you're worried about an AI bubble popping, let's look at 3 practical ways to protect your portfolio. First, start with the fundamentals. Make sure you've got a financial cushion, enough cash to cover several months of living expenses. Because if markets do crash, the last thing you want is to be forced to sell investments at rock bottom prices. Next, check your risk tolerance. When markets are rising, everyone thinks they're fearless. But when the market suddenly drops 50%, panic usually kicks in. So ask yourself, could you stay calm? If the answer is no, it might be time to trim some risk now, while prices are still high. And finally, make sure your portfolio actually fits your age and goals. If you're 20, going heavy on equities might make perfect sense. If you're 60 and nearing retirement, that's probably far too risky. These are the absolute basics. Every investor should start here. The next thing to consider is to look beyond the US. A lot of people think that buying the S&P 500 is the best way to invest. But remember, 40% of that index is dominated by AI-heavy tech stocks. If that feels too risky, you do have other options. A good portfolio should be low cost and diversified across different stocks, industries, and ideally different countries. For instance, you can use ex-US ETFs or invest in European or emerging market funds and so on. Sure, if AI crashes, other markets will feel it too, but much less so if you've diversified internationally. Now, maybe you're thinking, but what if AI isn't a bubble? What if it really does change everything? Well, in that case, you don't want to miss out either. So instead of going all in or all out, you can buy global ETFs like the MSCI World ETF for developed markets or the FTSE All World ETF, which also includes emerging markets. Just bear in mind, even those global ETFs are still about 60% US stocks. So if the AI bubble does pop, you'll still feel some of the pain. But if the revolution succeeds, you'll benefit too. And history backs that up. After the dot-com crash, investors who diversified globally fared much better. So once again, diversification paid off. Personally, that's my own approach. Globally diversified and long-term focused. Because let's face it, trying to time the market almost never works. And finally, another way to sidestep some of the AI hype is by investing based on factors like size or value. For example, you could look at small cap ETFs that focus on smaller companies, none of which are the overhyped AI giants. Then there are value ETFs which target companies that are cheap relative to their fundamentals, or some investors even combine the two into small cap value ETFs, aiming for smaller, reasonably priced firms. Historically, this kind of approach has held up pretty well during tough markets. But of course, past performance isn't a guarantee. But even so, it's a useful alternative strategy. All of these factors could once again provide some stability if AI enthusiasm starts to fade. Look, in the end, technology can change everything. But investor psychology, that rarely does. In fact, I launched a newsletter that shares practical investing insights focusing on psychology and behavioral investing. The goal is to help you understand why we make emotional mistakes and give you strategies to stay calm and make smarter investment decisions. So if you want to build stronger investing discipline, sign up. I'll leave the link in the description below. And in the meantime, check out this video to find out why, even with a solid portfolio in place, what really drives your results as an investor isn't the portfolio itself, it's something else entirely. See you there, and remember to stay hooked on investing.